Now we got a really great panel of folks that are joining us. One of my favorite ladies around, Tracy Shuchart.
Hi,
How are
Tracy.
you?
Hey guys.
How have you been?
Good. How are you been?
Good.
Good,
Hi,
Good to
good.
Steven.
see you. And then we have Steven Van Metre and also Jeff Snider. And welcome, gentlemen, for the very first time to the Traders Summit. I'm so glad to have you both here.
Thanks.
Thank you.
All right. Well, we're gonna kick off with this panel, and I gotta just kind of give everybody a little bit of an introduction. Now, Tracy, did you title change again on me?
Not officially yet. No.
What? Oh gosh. All right. Well, I'm glad it. Well, you know what, Tracy, you really don't need an introduction. You've been here on the Trader Summit, might have been every event of the 4 events that we've had. Really wonderful to have you here. Steven Van Metre, very well-known YouTuber, but also a money manager. And Jeff Snider, you are the founder of Eurodollar University. Is that correct?
Sure. Yes.
All right. Well, I'm going to say, Jeff, I've recently been turned on to you over the last several months, and I actually stop and watch your videos now, and I subscribe, and every time they pop up, I'm like, ooh, I got to see what Jeff has to say. So it's really a pleasure to have you all here. And I know you guys are all working together on a project, which we'll talk about, there towards the end. But let me start off with we'll start off with you, Jeff, just because we've had so many macro people on over the last few days. I want to get your take on the current environment and where we're at as far as let's talk about the terminal rate and where the Fed thinks, or where the market thinks the Fed's going to go. And I really wanted to get your take on, do you think that the Fed's they have the gut or the stomach to keep rates high, or do you think that we're raising rates, we're in a rate hike regime where the Fed's going to eventually just be able to lower them quickly like we've seen in the past? What are your thoughts there?
Well, it's almost like there's two different thoughts. The Fed is definitely demonstrated that it has a little bit more backbone than it maybe had in the recent past. And the market is trying to come to terms with where exactly they're going to stop, and more importantly, why they're going to stop. So I think the Fed has in mind that, as long as the CPI in the US remains relatively high, or the PCE deflator, whichever part of the consumer price buckets or methodology they want to focus on, it's been stubborn. They've made very plain that the mandate is now a sole mandate, that they're going to focus only on consumer prices. And so long as consumer prices remain elevated, and until they go down and demonstrate they're going to stay down, the Fed has indicated that it's going to continue hiking rates, maybe not continue hiking rates, but get to a certain point and then say, we're going to keep rates here until we see evidence in the actual consumer price numbers that shows they're working. Now, the market is kind of thinking, yeah, we get that message from you that you're focused on CPI. CPIs are being stubborn, but there are all sorts of concerning things going on in the world that may interrupt the Fed's plans. So as focused as the Fed is on consumer prices, the market has an eye on the Fed and consumer prices, but an eye on a bunch of other things that say, yeah, okay, you're going to want to hike rates, but I think you're going to have to turn around and actually start cutting rates again. We've kind of gotten a flavor of that over the last month or so. Stuff in the UK. We've seen dollar swap now. It's dollar swap issues in Switzerland, all sorts of funding problems around the world, Japan, the yen. So any number of monetary issues that could, if they really get going further than they have, that would certainly interrupt the Fed's plans, along with, let's face it, we're looking at a global recession, a high probability for a global recession. And you put those two possibilities together, and you do see a bunch of scenarios where the Fed may want to continue hiking rates, may want to keep rates high, but maybe it doesn't have maybe the choice isn't Jay Powell's.
I was talking with Danielle DiMartino Booth a couple of days ago on the Trader Summit, and I used a really poor analogy by saying this, but you think about like what the Fed's trying to do is just choke off, basically just money supply and just really fiscal policy, just bring it to a screeching halt. But you choke it off by if like you're choking somebody, you're not going to just choke and let go, right? there might be other indications that you would be looking at that might not let the Fed, take the foot off the gas. And so right now, as you see it, what are these other indications that might really suggest the Fed, lay off a little?
Well, there's a number of them, and they don't really have to do with the Fed. It's actually balance sheet problems in the global banking system, which is where all the dollars actually come from. They don't come from the Federal Reserve, and the Fed is basically hiking rates as more symbolism than anything. And that in the actual monetary system, the primary problem is always collateral. We have a collateral scarcity issue going all the way back to the first financial crisis in 2008, and that erupts and becomes a very big issue at times. And really, that's probably the primary monetary issue into 2021 or 2022 this year has been just collateral scarcity. You see it in any number of indications, including, ironically, GC repo rates, which you would think low GC repo rates would equate with too much money, but it's actually too little collateral. And so you see things like T-bill spreads, SOFR spreads, term SOFR, any number of money market indications that tell you there's not enough collateral in the system, and that is a huge, huge problem, and it's a repeated problem. So if there is a monetary issue that's going to that's going to get the Fed out of its rate hikes, it's probably going to be related to collateral.
Interesting. All right, thank you, Jeff. Steven, I'm going to turn my attention to you really quick. As we've discussed on the side, I've become quite a fan of your videos, because what you do is you really take all of this research, and I still try to figure out, I get a lot of research, but you get it all somehow. and you get all this research, but what you do is you break it down so the person at home that may not necessarily be a trader on Wall Street, but they could be, you still break it down to a way that people have a great and much easier way to understand everything about how the banks are thinking about things. But I want to ask you this, because you are a portfolio manager and a risk manager. So what are some recent events like here over the last few weeks that have really got you staying up late at night and keeping you awake at night?
Well, thanks, Blake. Unfortunately, nothing really keeps me awake at night anymore. We're at the level of, I'm just not surprised now. And I think that is a frightening thing. I know Jeff and Tracy would probably both agree with me, but I think really what I'm looking at now, Blake, is we've had this really rapid move higher in rates. Not only is it just a quick move, it's the fastest move higher in rates. And, from a portfolio standpoint, people, like to point their fingers, say, look, bonds are down, how bad is that? It's like, you don't understand. When the lags of this really tight monetary policy kick in, we see mortgage rates over 7%, and you're not seeing disastrous news in the housing market yet. So people are acting like, hey, this is no big deal. Look, rates can keep going higher. The Fed has got this. It's okay. Let's buy stocks. And what scares me, Blake, is at some point we know, we don't have any way to time this, but we know that monetary policy hits the economy with long and variable lags. The problem is we don't know how long, and we don't know what the variables are. What we do know is one day it finally shows up. And that's what concerns me, is I think we're getting closer. And what are we starting to see? We're seeing container rates tumbling. We're seeing new order as rates stay low in contraction and are pointing down. We're seeing some indicators here that are saying, not just from what Jeff's warning us from a monetary perspective, but we're actually starting to see these things. I have a fear that in the next couple months, particularly as we go into the holiday season now, another big thing that concerns me is we have record inventory levels. We have sky high interest rates. We know the Fed's trying to, restrain demand. And I just wonder how many consumers are going to pull out their credit card statements, the next month and look at that and say, wow, my minimum payment's going up, the rate's going up. I've got this big balance because we took on more debt than ever now. And if they stop spending going into the holiday season, now this inventory overhang goes into next year, and it's game over for retailers and wholesalers.
You bring up a lot of disinflationary type of ideas here, and we just got off with Jim Bianco, as you've seen, and he's an inflationista, and which I actually kind of sit in your camp. my wife was just talking about shipping rates last year versus this year for her company. It's like 80% cut. It's crazy from overseas, and those are kind of pressures that were going to weigh on the economy. But how do you think it's going to affect like behavior from a consumer standpoint?
Well, I think that's what high rates do. I think that's what the Fed, we know the Fed cannot, make people go out and buy or change them. But what they can do is say, hey, before you go out and buy that car, do you want to pay 0% or 10%? Do you want to buy that home at 8% mortgage or 4%? And that just gets people to change their mindset. So I actually did hear the end of Jim's presentation. And, he made a pretty good point that, owner equivalent rents are going to be a problem, and they are going to be a problem for several months, perhaps. But one thing that we know is that the CPI has a high correlation to gasoline prices on a year-over-year comp. I mean, we're talking early January, early to late January, maybe begin to February, where that, if gas prices just hold still, that goes to zero. We know WTI has a high correlation to producer price index. We're pretty much effectively at the zero there. So, we're seeing these things that are going to feed into the CPI. As we all know, it's a lagged indicator that tells us that inflation is likely to come down. You tack on import prices, again, high correlation to the CPI. They're coming back down. So a lot of signs, as you mentioned, container prices that your wife mentioned, there's just all these disinflationary prints. Now, maybe OER keeps inflation up a little bit, but I think we'll see the headline come down and you start to make the case for why the Fed maybe sooner to be a pause. But the real catalyst, what's it going to break that causes them to go right back to zero?
Yeah, I was just having, again, I'll mention her name again because it was a really good conversation the other day with Danielle DiMartino Booth, and she made mention of regarding rents, and this is why I bring this up, is the permits for like multifamily type of dwellings has gone up so dramatically. Rents are so high, you can see it, and I have like nephews that are in their mid-20s. And they've kind of kissed the American dream goodbye, if you will. And how many of that generation are just going to move back in with their parents or other family members? I'm assuming a lot, right? With rents at these levels. Yeah,
it's interesting because for the first time in my life, I'm a renter. We just sold our home and moved, and a lot of people are like, "Wow, you're renting." It's like, well, why would I buy at these prices? I mean, they're ridiculous. And in fact, I was talking to a client the other day, and I said something like, because he was talking about his son was getting out of the military and reintegrating into civilian life, and I said, and he says, Steve, I listened to your research. I get it, but are you sure that things are going to come down? And I just said, hey, do you think your son can go out and buy a home today? And he's like, he can't even afford the down payment. I said, even if you gave him the money, can he afford to make the monthly payment? And he's like, no, he can't. And I'm like, and that's the problem, is rates have now become restrictive. The Fed doesn't think so because, of course, we know the CPI is very lagged. And unfortunately, as Jeff mentioned, they're fixated on that, which will be a problem. But I still think about like what happens, what breaks, because you have this simultaneous effect of a very rapid rise in interest rates. At the same time, you see a very rapid rise in the dollar. Now, I can do a chart of either the dollar or interest rates when they spike like this, and I can put the word crisis or something crisis-like by it, but now we have both of them at the same time. I think what people are missing is how fast the Fed could be back at zero. As Jeff mentioned, they don't want to be there, but something's going to cause them to get there.
Yeah. All right. Well, Tracy, I didn't want you to feel disincluded because I was saving the best for last. Sorry, gents. Tracy, it's good to have you here as always. But you always have one eye on the energy markets and sometimes both eyes, I'm sure. This fall or this winter is going to be a tough one. And a lot of people think it's just going to be bad for Europeans. But, I can't remember if it was the Wall Street Journal or Bloomberg. I just saw an article the other day how, or maybe it was Axios, I forget, where energy costs here in the U.S. are going to be quite high as well going into the winter. How are you seeing the energy markets, and how are you seeing it that it could really affect the economy, not only here in the U.S., but globally?
Well, I mean, I think you have to really, the Northeast is going to have the worst problem right now. It's because of the exact same reason that Europe has problems. Not enough pipelines. There's not enough storage. There's not enough anything up there. So if you look at the rest of the country is kind of okay as far as, nat gas flows and whatnot, but the East Coast is going to be particularly affected. And so we are going to see higher prices there. And we are going to see higher electricity prices. I mean, we're already starting to see that just because the prices are elevated, and we have a massive distillate shortage heading into winter, which I've been warning about for months now. The government had plenty of time to try to help fix that problem by incentivizing refining capacity, but they haven't. So that is definitely going to affect your winter heating bills, across the country, actually. So that's really what we need to be concerned about, because those prices are going to remain elevated. I mean, if you look at the price of diesel right now, diesel's $5+ on a national average compared to gasoline that's like $3+ right? And those things are going to affect the diesel problem. The distillate problem is also going to affect agriculture, because a lot of diesel is used in agriculture and for transportation. So that's going to increase food prices. And then we also have to look at how much the military uses diesel. That's going to, they're going to need larger budgets in the military just to cover that problem. So this is a global problem, and it's, Europe is having the same issues.
So, talking about inflation, as we were just talking about inflation versus deflation or disinflationary pressures, how are you seeing inflation on the consumer level going into this fall?
Well, I mean, the problem is inflation, and I'm going to look at it from an energy standpoint, because that's really my focus, is that, demand is somewhat inelastic. People still have to go to work. People still, have to go to school. All these buildings need to be heated. So demand is somewhat inelastic. Now, when we start to see higher gas prices, like we did spike this summer, right, in July, we did see demand sort of come down a bit as far as gasoline was concerned, but we didn't see demand come down in the hospitality sector or in the airlines in particular. So I think that you could see, I mean, on the energy side, it's higher for longer. I mean, it just is. And so no matter what the Fed does, they're not going to be able to bring those prices down. And the other day with Biden's new energy plan, he basically put a floor under oil at $70, because he said that the government's going to buy it back at $70. So, at $70, that's still very high, comparatively speaking, than we've had on average over the last, 8-10 years. And so, again, we may see some pullback as far as, gasoline consumption is concerned, but really, again, I think these prices are going to remain elevated, and that's inflationary pressure, and the Fed cannot stop that, because it really comes down to, we don't have enough product, right? And we don't have enough refining capacity. And until that changes, prices are going to stay elevated.
That makes sense. All right. Well, I'm gonna turn it back over to Jeff really quick. But before I do that, I want to say, hey guys and gals, this is not common where you get a panel like this together, especially of these three rock stars. So if you have any questions, make sure you get them in kind of quick, because I'm gonna hit some audience questions early, since we've got three people to juggle. So make sure you get those in, and as I move along. So going back to you, Jeff, as far as the euro dollar, and this actually comes in from Jonathan. It says, can Jeff discuss how Eurodollar legacy contracts will affect the transition to SOFR? What's his outlook for the Forex and derivatives markets when June 2023 LIBOR deadline hits?
It's an interesting question. I think we're seeing some of the downside of the transition already. As far as the Eurodollar futures contract, technically speaking, that's already done. They've decided on an adjustment factor. I think it's 26.161 basis points. So they know basically how the contracts are going to roll next year. The real question is everybody that's pricing derivatives and floating rate notes and then any sort of credit production based on term SOFR, are they happy with being forced to term SOFR? And I think the answer is no, especially with the performance of term SOFR this year already. It has been as bad as many banks had been fearing all along, because SOFR, which is it's tied to actual domestic repo rate, so secured financing, versus LIBOR, which was an own rate, opinion-based, unsecured, offshore US dollar rate. The two could not be more different. And then they have performed very differently this year as rates have gone up. And we can't really directly observe the effects of that, but you have to, I mean, if you're a large credit producer underwriting tons of derivative contracts, the last thing you want is to be looking at your pricing benchmark and thinking, is this thing really telling me what I want it to? Am I really getting price information from SOFR that I'm supposed to? And so I wonder, Eurodollar futures are going to roll the term SOFR, but I wonder if we're going to start seeing more use of BISB or MRIBOR or something else. But the bigger question is, if SOFR isn't performing the way it's supposed to, does that have an effect on credit production? And I think the answer is yes, because the last thing you want to do as a producer is have questions about information and benchmark pricing. And it can have an impact where especially money dealers are thinking, I'm not really sure these prices are reflecting the underlying fundamental conditions, so I might not actually engage in this transaction like I would have if I had dependable benchmarks. So we don't know for sure exactly what's going on, but you can see how it can lead to some issues here.
Thank you, Jeff. I appreciate that. Steven, just in the conversations, you were talking about wages, and you don't see wages going up anytime in the near future. Why do you feel that way?
Because we're seeing demand slow down, and that's kind of the issue here. Is we note that if you look at the JOLTS, the Job Openings and Labor Turnover Survey, which we could argue that it may be one of the most worthless surveys that the Fed does or the government does because it's highly inaccurate, but it's also highly correlated with the stock market. So as the market goes down, we see job openings go down. But the other factor that I think people are really overlooking here is as the market goes down, you have a lot of baby boomers that retired, into the pandemic and even in the later parts of the pandemic, because they were looking at their stock portfolio and going like, wow, if this just keeps going up to 30% a year, it doesn't matter that I don't have enough money. I can keep my lifestyle. I can retire. Well, the more the market goes down, what happens is you'll see the boomers come back into the workforce. But unlike their millennial children, the boomers who will either have Social Security, a pension, or both, they won't need as much money. They'll just need to supplement, whatever their shortfall is that they don't want to take out of their stock portfolio now. And what they'll do is they'll come back into the workforce, they'll undercut the millennials, and you'll see that drive wages down.
All right, thank you very much. And Tracy, this next question is for you, but before I get into it, I'm gonna take a step back and just say towards the end, right around the last few minutes, I'm gonna ask you guys if you have any opinions on what your best actionable idea is in the markets, like where you think investors should be positioned over the next few weeks as we head into the fall. Seasonality might play, that type of thing. So just wanted to see if you guys have any like strong ideas on where to be in the markets. But this one to you, Trace. Saudi Arabia wants to join the BRICS. If they do, how will it influence oil prices and the dollar?
Well, it makes sense for Saudi Arabia to want to join this alliance. You already have Iran that's already in OPEC, and you also have China is Saudi Arabia's largest oil customer. So that makes sense. In addition, because of the threats from the United States, Saudi Arabia is also looking to protect themselves a bit, right? Because we're starting to talk about the NOPEC bill and possibly seizing assets, which Saudi Arabia owns, the largest refinery in America, which is Motiva. If we start, talking about taking their assets, which is paramount to a global oil war, you're going to see prices shoot up crazy. So I don't think this will actually pass, but theoretically, if it did, prices would shoot up. You'd have OPEC just not sell to the US anymore, which we do need their oil. It would be a huge disaster for the United States because our oil prices would just skyrocket. Aside from that, oil's still priced in dollars, right? And being the fact that it's the strongest currency right now, there aren't any other real currencies you want to be trading oil in, right? Everybody's wanting dollars. Dollars the strongest currency. Other ideas have floated around before. The euro, there's some that is traded in euro, some a little bit that's traded in yuan, but really, do you want those currencies right now? No, you want dollars. And so
I see heads. Everybody's heads doing this. All right, go ahead. Sorry, Tracy.
So you want dollars. So not really worried about the impact on oil being traded in dollars, right? Because everybody kind of wants dollars at this point. Everybody's short of dollars at this point. And so I don't see that being affected. But as far as BRICS is concerned, I think that is it does make sense geopolitically, and it does give Saudi Arabia a little bit of a buffer, with the United States kind of going after them right now.
Gotcha. Thank you, Tracy. Jeff, this question comes in from Jim. Can you explain why banks aren't expanding their balance sheets?
They don't want to.
Okay.
No, it's simple. It's always a question of risk-adjusted return, or perceptions of risk-adjusted return. And if the perception of risk goes up for any number of reasons, whether it's volatility, correlation, whatever the mathematical property could be, feeding through. And really, again, as I said before, collateral shortage, which feeds into liquidity risk, the last thing you want to do is expand your balance sheet. In fact, you want to take risk off the table, regardless of sometimes, you think about it in the swap market, for example, there's massive amounts of arbitrage that are available right now that banks are just leaving on the table because they're balance sheet constrained. And the reason they're balance sheet constrained is because they see a high degree of risk. If your risk perceptions are that, volatility is going to go up, or, the economy is not really good, if keep it in general terms, you don't expand your balance sheet. And the problem is we need them to expand their balance sheet because, as Tracy just said, there's a reason why the dollar is the quote unquote strongest currency. It's the fact that there aren't enough dollars out there in the world. And without enough dollars out there in the world, it's basically a massive margin call on everybody, including those who live in the US. We just don't realize it just yet. So without banks expanding their balance sheet, and without them having the positive, favorable risk perceptions, we're kind of stuck here. And that's really getting back to your original question. I think the question that's on everybody's mind. What is it that, that Steve talked about? What is it that gets the Fed out of its rate hikes? Well, a massive dollar shortage and a massive dollar squeeze across the world would be one of those things if it continues to erode economic and financial fundamentals everywhere else.
All right, thank you very much. And that was a really, really great answer. This one's to Steven. What is your political affiliation, and which way are you going to vote during the midterm? I'm joking.
Yes, Steve, tell us. Come on, go.
Yes, everybody wants to know.
No, this one comes in from one of our attendees, though. Will the U.S. election results with potential political stagnation as a result be a catalyst that will speed up the path towards deflation and recession? What are your thoughts based on the research that you've been doing, Steven?
Yeah, I don't think the election matters as much. I hear that from a lot of people. I'll come back in the market after election, or I'll do this after election. It's like, look, it doesn't matter at this point, who is in Congress. It could be nobody, and that might even be the better solution, because if somebody can tell me why flipping Congress would actually change the fact that somebody is going to go out and pay nearly 8% for a 30-year mortgage, how that's going to get all of these builders who are sitting on massive amounts of inventory to clear that out, how that's going to get people down to the stores and unload, all of this inventory piling up. If someone could explain that to me, I'd like to know. Now, as far as I can tell, it doesn't matter who's in power. Now, maybe if Republicans do take over, we finally start to see perhaps a move back to a balanced budget, which wouldn't be a bad thing at this point to begin with. But in terms of some massive shift, I don't think so, because something Jeff and I talked about on his show not too long ago. He and I do a weekly recap of what's going on in the markets. When you hear this thing from investors that, hey, as soon as the Fed pauses or pivots, it's super bullish for stocks. And yet I could pull up a chart, and I'm not the best chartist out here by far. And I can show you that every time the Fed pauses or starts to cut, it's usually bad news for the market. And that's kind of what Jeff said on his show. He's like, yeah, everybody thinks they want that. But by the time the Fed starts cutting, it usually means things are much worse than we thought. So I don't think the election makes too much of a difference. Maybe people start buying stocks from it, but right now U.S. investors are crazy bullish anyways. So as far as I'm seeing things, Blake, it tells me those monetary lags are going to start grinding in, and that will be the big factor.
Interesting. Okay. And what? How are you voting? Did you say? I'm joking. Tracy, this one's for you. Whoops, sorry, it just disappeared. Oh, here it is. Seeing Biden administration being anti-fossil fuel and draining SPR to 40-year lows, which they will have to buy at much higher prices, and Europe being in energy crisis, where do you see oil price targeting for upcoming 2 years? Will it stay above 120 for longer term? That's from Corollis.
Well, I think, I hate to kind of guess, because there's so many mitigating factors in this market. I mean, a million things can happen between now and then, but, I definitely think that, we're going to continue to see, prices elevated, and I wouldn't be surprised to see, us back over 100 and stay there for a while, because, really we've had no capex in the market for the last 7 years. Right. And we have demand only set to grow globally, right? Particularly in Asia, particularly with India. So, if we just don't have enough supply, it's a global, it's a global problem, because there's just not enough capex, and we have such, to get to where we have supply demand balance per se, over the next 5 years, we have like a $750 billion capex gap there between, what we supply to bring online to meet growth demands. So, again, I think oil is, higher for longer.
All right. Well, that's you heard it from Tracy herself. Now, this question is for Jeff, and then after that, I've got a question that maybe can be for all three of you. James asked to you, Jeff, collateral damage. To what extent has the U.S. collateral moved into China bonds and tech stocks at a loss added to collateral shortage?
That's an interesting idea. Again, there's no way to tell, because it's one of those transparent, opaque parts of the collateral system. But you have to wonder, especially back in late 2020 into early 2021, when everybody was feeling really good, everybody was feeling really inflation-y, a lot of risk taking place. How much of that, all sorts, not just those, but all sorts of junk kinds of collateral that entered the stream, and dealers were willing to accept any number of lower quality credits as relatively, low haircuts, decent prices. Now that the world looks very, very different, everything's going to, anything tied to Asia, Eurobonds that are now that are issued in emerging markets, all of those kinds of things, CLOs, US dollar denominated CLOs, leverage loans that go into those. There's any number of factors where you could look at any number of issues where you could look at these collateral chains and say, yeah, I could see why they would start to reverse, especially when you get more perceptions about recession, more fears about economic risk, as well as other forms of balance sheet constraints. And it's a recipe for everything that we're already seeing. And that's really you look at something like credit spreads. Credit spreads are up, but they're not up all that much. They're certainly nowhere near they were in 2020. Yet we just went through one of the worst collateral squeezes at the end of last quarter, at the end of last month, end of September, that we've seen in almost a decade. So there's room for whatever's going wrong here to go wronger still. and it could lead to any number of financial, economic problems down the road. And that's, I mean, it's almost like take your pick at this time. There's so much stuff that got involved or that got infected into the collateral streams last year on a lot of mistaken assumptions, which that's what happens every time you go through these cycles. And there's no shortage of potential problems or fault lines that could trip everything up going forward, more than it already has. Again, that's really the scary part is, you know, you look at repo fails at the end of September, which were almost $1 trillion for the final week, and credit spreads weren't up that all that much. I mean, they're elevated, but there's still room to go.
So that just suggests that things could still break further, if you will.
Yeah. And again, I keep going back to the original discussion. What is it that gets the Fed out of rate hikes? Well, a worse collateral squeeze than we've already seen would probably do it, and probably do it, as Steve says, not only get them out of rate hikes, but thinking about QE relatively quickly. You know, that's
sorry, yeah, okay. And I'm sorry, I hate to interrupt, but that actually brings me to this last question I want to ask the three of you, if you have an answer for. This comes from James, a different James though. He said, we know there's a lag between monetary and market reaction / real economy function. Can any of you paint a scenario in which, if or when the Fed will pivot, the markets and the real economy does not respond in the way we think? An example, go up, ? Even with the lag, the answers I come up with as I thought about it is, 1, the threat of inflation, and 2, the loss of all confidence. So do you guys see a world at all, a scenario where the Fed does pivot? Let's start with you, Steven.
No, the Fed will pivot. Absolutely. There's literally no question. I mean, it may not be the stock market this time that gets them to do that. And I don't think the Fed cares much if the stock market keeps going down. I mean, I know investors like, oh, they'll run to the rescue. Look, you go back to Greenspan, he was the first who really pointed out what this wealth effect is. If you're trying to cut demand and you are a Federal Reserve, chairman, what is a good way to do it? Keep driving stock prices down. And even though, Jeff is probably laughing underneath his breath right now that they have no control of stock prices, and he's right, they don't. But there's a psychological thing called a balance sheet runoff that even if the Fed pauses, so let's just say in November, they say, we're going to hold steady and we're going to give, a couple months to see if things are okay, and then we'll continue forward. The psychological effect of quantitative tightening is all that you need, because how many people are putting out charts saying, look, QT go, we see the balance sheet go down, stocks go down. Well, that has an effect there. So, but in the end of the day, the business cycle is still intact. It's still there. What will get the Fed to pause is when all of a sudden you see a big jump followed by more jumps and unemployment claims. And that's when the Fed will realize that, it's too late, because once that ball starts to roll, you can't stop it.
Okay, so it's employment for you, Tracy, and they are going to eventually do it. Tracy, what do you think? What gets the Fed to actually pivot?
I mean, I think that when something breaks, because they always react. They're always reactionary rather than proactive, right?
Anticipatory.
Anticipatory, proactive, however you want to say that. But generally, right? They waited till inflation ran away, and then and now they're trying to hike at an incredible speed, right? And so I think that something will have to break in the market, and they'll be forced to pivot, and it'll be another reactionary move that probably the markets won't react exactly how they think, because something will have broken somewhere.
Yeah. Well, I mean, I guess we could probably argue that the bond market might actually be broke, right, Jeff?
Well, I mean, it depends on what you mean by broke.
Yeah.
I mean, the federal government certainly broke, and that that should be the primary driving factor for especially U.S. Treasuries. But then you look at the opposite side of it, which is the liquidity characteristics of the Treasury market, which I know people look at the move index and volatility, and I think they're misinterpreting that too. I think that's the bifurcation in the Treasury market, where everybody is, half the market. Not half, but parts of the market are saying we need to sell treasuries, inflation, rate hikes, and all that. And the other half of the Treasury market is, as Steve, QE pivot, all that stuff's coming down the road. And we don't have clarification on when that happens or which side is actually going to win in the marketplace. I think some of the others, related Eurodollar futures and other markets, swaps in particular, are pretty much settled that there is going to be a Fed pivot, and it's not just going to be a pause, it's going to be a full-on pivot. Nothing's ever 100% in the dynamic world we live in, but as far as these markets go, it's about as 100% as it can possibly get. And as we said, I mean, we've been sitting here talking about any number of reasons that would lead the Fed out of its position. And as Tracy was just saying, they are reactionary. They are never proactive. They're always behind. I know that the analogy Steve always used, what is it? They're driving the car with the windshield completely blacked out, trying to navigate through the rear view mirror. That's the Fed. And the market is saying there's all of these things that are going wrong progressively. They're progressively getting worse. I mean, just last week, we had the 3-month 10-year yield spread invert for the first time in the Treasury curve. The Treasury curve has progressed further and further and further toward the very kinds of scenarios that would force the Fed out of its inflation-only mandate. So, I think it's nothing is ever certain, but it's probably as close to certain as you can get. The only question remains is really when. Maybe there's a little bit of question about what, but really it's when do all of these things combine to get Jay Powell out of his Volcker, pretending to be Volcker.
And I'm going to tell you, I got a way that I'm going to figure it out before most, is because there's a way that myself or any other traders out there can follow the three of you rock stars together. And that, and I'm sure being a Markets Insider Pro subscriber would give me access to the three of you guys and be able to know exactly when you're feeling that the Fed is pivoting. So Steven, could you tell us a little bit about Markets Insider Pro and what you guys are doing over there?
Yeah, and I also want to go out on the limb because I love doing this. I'll say the fastest hiking cycle in history is going to be followed by the fastest cutting cycle in history. We'll see the Fed go to zero faster. Jeff loves this, I know. All right, so let's talk about Markets Insider Pro. So Jeff, Tracy, and I, we joined together with our research offering. And what we have in that, Jeff writes a daily research report, kind of goes through what's going on in the global economy, the economic data, tells us what he thinks about it, which is really invaluable. It's something I read, Blake, and I learned from Jeff. Same with Tracy. She does a weekly, and I think she might nod her head if she's going to twice a week soon. She is. Okay. So she covers energy and materials. And again, when I want to know something, I just pull up her report and say, hey, what is Tracy thinking? She goes through what are the key things that are going around in the energy and material sector and tells us what she thinks about it. And that's really, I think, really valuable because as just either an investor or a money manager, I want to know what these experts like Jeff and Tracy think. They do a great job. And then my piece of the puzzle is mostly a momentum-based research report I have that scans a bunch of ETFs, equity, bond, commodity, currency, international, you name it. And it runs a momentum screen over it to help people look for short-term and longer-term buy and sell signals. And then on top of that, I throw in some trade tips in the report as we see it. So right now, 1 month free. I put a coupon. This is for all Trader Summit people. They can go and get that now. And then that'll be, for those watching this on the replay, there'll be an email going out again with that coupon code as well.
Well, thank you very much. And real quick, I'm going to go around the horn. I know Anthony Crudelli, he's waiting in the wings. He's ready to go. But real quick, Jeff, in a sentence or two, where do you think we should be? Where do you think is the best place to have your money at this point?
I think you got to be very careful. Like, volatility is everywhere, but if you're looking for, I think, really a big winning trade, and this is, I mean, you got to be really careful because the downside risk is there, and the timing is everything. But going long treasuries, if Steve's right about the major rate cuts, and I think he is. Then it's soon at some point when the Fed says we're done, things look bad, you're going to see everybody pile into U.S. I think everybody is waiting to get into U.S. Treasuries. They just can't see the exact moment that happens. So if you can be careful about the short term because there's still downside risk in bonds, at some point when that happens, it's going to be a major move.
Value proposition. Tracy, how about you?
So I'm energy stocks, but again, I have to say, I have to agree with Jeff. Markets are very volatile right now. You have to be very careful. And so, I think if you're a longer term investor, which kind of is my outlook is, like 3 to 5 years, then these dips that we're getting in the energy sector, are good buying opportunities. Again, if you're planning to hold for a longer length of time, not to trade right now, I think is if you're just looking for a trade, markets are very volatile. I'd be careful out there.
So very good. And Steven, what about you?
There we go. Had myself on mute. I've liked the bond market. I know I get a lot of flack for liking it, but my thing was I want to be long bonds until the next crisis. I did not know when I put my thesis together there would be a massive pandemic. We'd see what we're seeing now. I'll tack on to what Jeff didn't say is that there's a ton of foreign investors, private investors that are buying bonds, record levels here. And, from a long-term management perspective, which is where I like to play, I want to hit these major cycles. I want to be selling bonds when rates are hitting zero. And I think there's a big argument that we could see rates now across the curve at zero. You've got potential financial crisis brewing. You've got massive inventory build. You've got all kinds of factors that could do that. And at that point, I'll be happy to sell and buy risk assets.
I love it. Guys, I want to say on the behalf of the Trader Summit community, having the three of you here at one time was awesome. Remember, Markets Insider Pros, where you can get the three of them together on the other side of the Trader Summit. So Jeff, Steve, Tracy, thank you so much for being here and blessing us with your time, your very valuable time on this Sunday.
Thank you.
Thanks, Blake.
Thank you so much.
Yeah,
Love you guys over at